All right. Today is Sunday, the 3rd of November. This is a recap for the macro and the market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight, and I mean that. It's going to be an inclusive coverage for everything you need to know about the macro and the market conditions right now, as we head to one of the most important weeks in market and perhaps economic history. Not to mention, of course, elections history. Now, of course, this video is going to be a little longer than what we've promised you for splitting the videos in half because we have elections this week, so we're going to be extra busy along with the earnings season. So we're going to combine all of the coverage in one video for tonight. And without further ado, let's dive right into it, folks. And we begin with what the hell is going on with the bond market. The Federal Reserve cut rates by 50 basis points, and the response that we got in bond yields was nothing, as at least what the experts predicted. And it certainly wasn't as what the logic would have predicted, that the Fed cuts rates, bond yields should go down. In other words, the interest rate in the economy should be going down because the Fed is cutting rates. What we've seen is the opposite. We have seen interest rates surging higher after the Fed cut rates by 50 basis points. And here comes the big debate. Why is it happening? We talked about this before, that perhaps one of the most important reasons why we see this divergence and this phenomenon is the fact that the bond market is betting that the Fed made a major mistake of overdoing the rate cuts when the economy doesn't really need the rate cuts. And on top of that, by doing this mistake, they're going to revive inflation back into the economy. But could it be that that's the only reason? Could there be another reason why we see huge volatility in the bond market? I begged the question, of course, on Twitter, X, whatever you want to call it, doesn't matter to me. But I showed you the monthly chart of the ticker MOVE, which is BofA's Bond Market Options Volatility Index. And as you can see, when we've seen surges in bond volatility, it was during times of stress, times of bad economics, times of bad market performance. We've seen that back in the financial crisis. We've seen that in the taper tantrum, as I'm highlighting in the chart, in the episode of Brexit, in the COVID episode, when the Fed began raising rates in the year 22, when we got a bear market. And now we see this massive surge all of a sudden in bond volatility. What is it all about? Is it a transitory reason why we see bond volatility moving higher? Or is it more fundamental and more sustainable? Of course, if it is the latter, then it is more serious and it will lead to major consequences in the market and the economy. If it is a transitory reason, what could it be? Think about that for a moment, but I'll lead you step by step here. What you're looking at right now in the chart that goes from red to green, then red again, that's the reverse repo market. And the chart in white is the 10-year yield. Now, usually we see reverse repo trading in correlation with bond yields going up or going down. They go up together, they go down together. But recently, we have seen a massive divergence where we see reverse repo trending down, but then we see the 10-year yield trending higher. When did we see that last time, besides the time that we got right now? In recent history, at least, we see it happening twice. If you go back in the year 2023, in the summer specifically, all the way to October, and the other time was in the beginning of 2024. Now, let's plug in the SPX in orange, the S&P 500. You can see in the divergence instance number 1, when reverse repo went down, but we've seen the 10-year yield going higher, as we see right now. The market was under a correction during that summer. In the divergence instance number 2, we see the opposite. We see bond yields going up, reverse repo going down, but the market going higher. What we have right now, at least it appears so, reverse repo heading down, yields going higher, and the market is beginning to break down. Why do we see such different reactions between 1 and 3 and then 2? Well, let's plug in here in blue the MOVE Bond Volatility Index. You see in the number 3 instance, the one that we have right now, we see bond volatility heading higher, along with yields heading higher, and the market coming back down. If we go back to the instance number 1, we see a similar phenomenon where the MOVE index was moving up, along with bond yields, while we see reverse repo and the market heading down. Now, in the instance marked at number 2, we see something different. We see bond yields going higher, we see reverse repo going down, but we see the market heading higher. In this case, we've seen the MOVE index heading down, and once it began to surge higher again, the market pulled back. So once we see a divergence between reverse repo and bond yields, and at the same time we see bond volatility heading higher, usually it's not a good time for the market. This is, of course, not the only divergence that we got. We've been having divergences for a long time now. And one that's been going on since the year 23 is what we see between the JOLTS, J-O-L-T, this is the job openings data, in black. And then you see what's going on with the SPX, the S&P 500. Usually they trend together. We see more job openings, the market does better. We see job openings trending down, the market does worse. But right now we have a massive divergence. Another really interesting divergence is what we see between gold and the dollar. Gold in orange, of course, the dollar in green. Lately, they've been trading together. Usually, they trade against each other, but one goes higher, the other goes down. Primarily, of course, when the dollar goes higher, gold goes down. When the dollar goes down, gold goes higher. But now we see both of them heading higher together. What else can we plug into this equation that we have? How about the TLT? A representative of bonds, not bond yields, but bonds. And in this case, we see both the dollar and gold heading higher, but bonds going down. Now, usually bonds trade along with gold. You don't see a divergence between gold and bonds. Except, of course, if we go back, we have few instances we've seen such a divergence. And mostly, it goes back in the year 22. You see bonds trending down, but you see the dollar and gold heading higher. And that was right about the time when the Fed began raising rates. So are we now debating the Fed raising rates if we're talking about perhaps the Fed made a mistake by cutting rates with 50 basis points when the economy clearly didn't need it and it was excessive enough to bring back inflation fears? We have an FOMC meeting happening after the elections. Would we see a decision of interest rate hikes? My 2 cents, I doubt it. But perhaps the bond market is leading the Fed toward at least you gotta pause. Because if you cut again, bond yields might continue to go higher, indicating that you're continuing in a wrong path. I think the Federal Reserve usually listens and usually considers how the bond market reacts to its decisions because it's sort of a feedback. And if they get a negative feedback, then they have to reassess their decisions. But we go back to the main question. Are these divergences a product of a transitory element, or is it something more sustainable? Something more sustainable would be Fed policy, for example, fears of inflation. Something transitory could be what we talked about over the week. And I made the video public so everybody can be on the same page. We talked about optimism is exhausted, fear is about to storm in. And we discussed what Jim Bianco floated, which is the fact that we see bond volatility and bond yields heading higher the moment Donald Trump took the lead in the elections polls. As if the market is not really worried about inflation or the Fed policy, but these divergences are more of a product of the elections fears, specifically the fears of one candidate winning the elections, and that is Trump. If that is the case, then what happens to all of these divergences after the elections? Will they be resolved, or will they last? Because the elections was not the main catalyst for these divergences. I think that's the most important question that we all have to think about before the beginning of this week. Now, bear in mind that there is something else you have to keep in mind, and maybe it is tied to what we just talked about, maybe not. I always said that if we have a global systemic event, it will probably begin in the UK, because that is the most fragile, advanced economy among them all. And this week we have seen also insane volatility in the UK bond market. Yields been going higher, but the price of bonds is collapsing. Again, is it fears about the US elections? Is it something happening in the UK, something breaking behind it all? And is that spilling over where somebody here in the US, at least some investors, are sniffing that out? And this is why we see the divergences, and this is why we see the VIX going higher. That something is going on overseas, in Britain, to be specific, that is about to spill over. All of these are good questions. We're not going to know the answer, of course, until the shit hits the fan. But it is worth discussing. And I'd love to hear what you guys think about all of this in the comment section. But we're going to talk about one of them in tonight's video, which is the elections. What if the elections is leading to all of this volatility? So let's expand what we just talked about and visit the hierarchy of events. As we begin each week, we talk about the hierarchy of events, what's going to impact the market more. And the hierarchy of events for this week will definitely begin with the elections, then the Fed policy. And this week, we're not talking about a piece of macro data. We're talking about the actual Fed policy. We have an FOMC meeting, and then the geopolitics, because that goes hand in hand with the elections. Whatever the outcome of the election is, if we get it right away, will have implications on how we view the risk of geopolitics. Then we have the technicals at number 4 and taking the back seat from being at the driver's seat this week. It's going to go back to the back seat. That's earnings at number 5 at the bottom. Let's discuss all of these events, beginning with the elections. Now, I've been saying this for a while. A lot of folks are saying, Maverick, I think the market is fearful of the elections because we might have a contested election. We might have somewhat of a revolt or civil war because of the results. And I said, look, I don't see it that way. I think the results will be decisive, clear, and we'll have it early this time around because somebody's going to capture Pennsylvania fast. And according to the polls and the latest trends, it'll probably be the orange man. And if the orange man wins Pennsylvania, then he's winning Georgia, he's winning Arizona, he's probably winning Nevada too. And that's enough to win the elections. But then, we've all seen what happened over the weekend with the funny business at the betting markets and the polls. So you see at the betting market what happened here over the weekend. Trump was leading by a huge margin over Kamala, at least recently. And over the weekend, magically, we've seen a surge in the odds of Kamala winning over Donald Trump. 51 to 49, perhaps higher right now. And then we've seen funny business in the polls. On Friday, Iowa is a state that everybody's assuming that it's going to be in the bag for Trump. If we talk about Trump winning Arizona or Pennsylvania, of course he's winning Iowa. But the Des Moines Register says that Harris is leading by 3 points over Trump in Iowa. If that is the case, then she's winning Michigan, she's winning Wisconsin, she's winning Pennsylvania, she's winning perhaps Nevada, Arizona, if not even Georgia. But then you have the other Iowa Emerson poll that shows Trump up by about 10 points. What do I think about all of this? I think the truth is in the middle. I think that Trump is leading Iowa. He's leading in North Carolina too, despite what the polls try to show it as, it's too close. What's close is the states that we talked about before, the Midwest, Georgia, Arizona, and Nevada. Now, as far as the betting markets, and I said this before in the program, I don't trust the betting markets because what is that going to show you? What the gamblers are thinking about the elections? We know that Kamala supporters are over 65 years old. Are they really using these betting apps and betting sites as much as the Trump supporters? Maybe that's why we see the divergence, and maybe Trump was not leading as much as the betting markets were showing. And these betting sites, they have a reputation to protect. And if they think that Kamala's going to win, despite what the bettors are saying, they're going to move the odds higher just to say, look, folks, we told you she's going to win. We predicted that right at the end. So we're accurate right now. Please trust us and give us money for the next elections. But again, we got to play the devil's advocate. What if the elections will be a mess? What if it is too tight and we're not going to know the results right away? In other words, I begin to think, even though I thought it would be easy, but I begin to play the devil's advocate and begin to think about what you folks have been saying all along, that there is real risk behind the elections. It's probably going to be contested and maybe we'll see violence after, who knows. And when you see the polls and the betting odds switching like this, maybe there's something more into it and I'm missing out on it, perhaps. And again, we're never going to know until after the elections. What we can talk about in this program, what do we think the outcome would be based on the economy? Of course, the media such as The Economist, which is a propaganda wing for British intelligence, or lack of intelligence, the James Bond folks. And of course, they want the war in Ukraine and NATO and all of that, so they have a certain administration that they fear. So the headline from The Economist is, America's glorious economy should help Kamala Harris. Voters are starting to notice the good news just in time for the elections. Now, The Atlantic, which is a propaganda wing for U.S. intelligence, the CIA, and they say that the Trump tariff talk might already be hurting the economy. So you hear the negative headlines right before the elections. Then we have the Washington Post, the Bezos CIA Washington Post. We don't have free media, by the way, just in case you thought. It's just owned by intelligence and the Pentagon, governments, and the billionaires all together. But the Washington Post says, see how the Inflation Reduction Act is affecting your community. As in, hey, stop complaining. The administration did pretty good for you. Just see how the Inflation Reduction Act is helping you out. Now, is this a true reflection of the voter? And most importantly, will the voter believe this narrative or not? What supports this narrative is the unemployment rate. So we see the unemployment rate 4.1 before the elections. And usually, if the unemployment rate is low before the elections, the incumbent party wins. We don't see a change in administration. So this is the case for the Kamala Harris campaign to win. That unemployment is low, and maybe the perception of the economy is better than we expect. That folks think that, hey, the Inflation Reduction Act and maybe the Trump tariffs, worse for me and worse for the country, then Kamala could win. And of course, the other catalyst would be if we have a higher turnout of the female vote, because the Democrats been talking about one issue throughout this whole election season. They can't really talk about the economy, so it's all about abortion, a woman this, a woman that. Right? And if the woman turnout is higher than expected, then it could move things a certain way, as we've seen, by the way, in the midterms in 22. What is the case for Trump to win, though? If the predominant issue in the mind of the voter is the economy, and the perception of the economy is not what the Atlantic, or what the Economist, or what the Washington Post is projecting, or CNBC for that matter, it's actually what the reality of the consumer reflects here in the U.S., where we see a lot of segments of the consumer getting absolutely annihilated. Because here we have another intelligence propaganda wing, which we call the Wall Street Journal. It's a combination of intelligence, Pentagon, and the hedge funds and the banksters. And they say that the next president inherits a remarkable economy, as if they're buttering us. For, hey, Trump is going to win, but he inherited a great economy. And if anything goes bad from this point on, it's his fault. Maybe they know that the economy is heading for a crash. It's just a matter of time. And we'll show you the data in a minute. And we don't want to assume the responsibility. Let the other guy assume the responsibility. It seems to me that they're hinting for that. But once again, why would Trump win if the predominant issue in the mind of the voter is the economy? You look at certain inflation. Of course, the media and the administration say, but inflation is down. The Federal Reserve says that we're closer to the Fed target of 2%. That's not going to do shit to the perception of inflation in the economy. And to be honest, the reality of inflation, just because it's increasing at 2%, that doesn't erase the damage that took place over the last few years. It's cumulative. And unless you have price reduction, if you have deflation in the economy, then we'll feel better. And we know that that's not achievable without a stock market crash and a recession. So all of this reduction in the rate of growth in inflation to 2.3, 2.5, whatever statistic they want to give you, it ain't really landing with the voter. Why? Because the cumulative rise in pricing is huge in certain categories. In electricity, in beef, those are still going higher. The question becomes, what about workers' wages? Are they really keeping up with the rate of inflation in the economy? If you listen to the propaganda media, they would say yes, because the data says that wage inflation, blah, 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 blah. But in reality, when you look at the majority of the increase in weekly earnings, it's happening among the rich. It is happening among the tech workers, the AI mania spending. But the regular folks are not really seeing any impressive increase in inflation-adjusted weekly earnings. But would you lump all of us together with the tech workers and the rich and all of that? Sure, of course, we look pretty good on paper. Wages have been going higher above the inflation rate. Now take the rich, take the tech workers out of the picture, and it looks drastically different. The headline from Reuters says for many U.S. voters, the economy is personal, and they blame the Democrats. Go read the article. It's actually an interview of Democratic voters who say that they're going to vote for the other side this time around because of the economy. Now, so far, we discussed the case for each candidate to win the elections. The case for Kamala, perception of the economy is actually better. And oh, by the way, the most predominant issue in the mind of the voter is abortion, not the economy. The case for Trump to win, the perception of the economy is accurate, what we've been talking about. And the number one issue in the top of the mind of the voter is the economy. Then he wins. Now let's talk about what scares the market specifically about a Trump win. Because in the beginning of the show, when I showed you the divergences, we said reason number one is maybe the Fed will have to raise rates. Maybe inflation is not defeated yet. And this is why we see all of these divergences with specifically bond yields going higher. But we also talked about maybe, according to Jim Bianco at least, and I think it's a great research, that a huge part of bond volatility is happening, or let's say that the surge in bond yields is happening because the market began pricing in a Trump victory in the elections. What if the two are tied together, the Fed policy and a Trump win? What supports that is if Trump wins, deportations will probably increase. It is no surprise that having an open border for years has been pretty good for reducing inflation. You get workers who are willing to work for starvation wages in the economy, and of course that's going to reduce the rate of inflation. But if we see deportations, as the Congressional Budget Office and the Peterson Institute of International Economics shows, if we see deportations going higher, the rate of inflation is also going to head higher. In the case of 8.3 million deportations, then we'll see a surge in inflation. In the case of 1.3 million deportations, then we'll see stickier inflation. The other thing is, if Trump wins, we know that tariffs would be an issue. And it shows here that the consumer price index, the CPI, will go higher if we have tariffs 10% or 60% against China. Any tariffs will lead to higher inflation. What if that's the explanation here? The market is afraid about a Trump win because it could lead to higher inflation on top of the Fed's mistake, and it will lead the Fed to raise rates down the line. That's an intriguing thought, and we'll see what happens. If Kamala wins, in this case, then wouldn't bond yields and the dollar go down, and we see a different reaction in the market? And if Trump wins and we see yields going higher and the dollar going higher and gold perhaps going higher too, and the volatility, bonds and stocks going higher, then maybe the market was afraid of a Trump victory more than a Kamala victory. Now let's discuss here, at least rationally. Whatever happens is up for grabs, but rationally, what do we expect, at least from a stock market reaction? A Trump win or a Kamala win, and of course, what happens in Congress, what group of stocks is it going to be good for and bad for? If we begin with scenario number one, that we see Kamala wins the presidency, but then the Republicans win Congress. Well, a split government, I think that's going to be a relief for the market because it is the same administration, the status quo. Nothing changes, just different faces. So I think it's going to be good for most stocks and the bond market. We finally see relief in the bond market. Of course, it's going to be bad for anything that was pricing in a Trump win, be it the stock DJT or Bitcoin and the crypto sphere, of course. Now, suppose the Democrats win both president and Congress. But I don't think that's going to be good for stocks because now we got to fear the legislation. We got to fear the policy. They're having supermajority. Of course, that's going to be bad for anything that they accuse of price gouging. Think about the consumer companies, the staples, for example, the food companies. Think about anything that relates to gasoline stations or even the insurance companies. They might come after them, accusing them of price gouging. Of course, it ain't going to be good for big pharma. It's probably not going to be good for big tech because now we have to assume that more and more regulations, more and more lawsuits will hit big technology company stocks. It could be good for defense stocks, aka war stocks. They've been trending down recently after the earnings from Lockheed and Raytheon. We see a little bit of a sell-off or profit taking. And maybe it is justified because who the hell knows who's going to win the presidency? But what if defense stocks are looking for a Democratic win? Because the Democrats love all wars. They love Ukraine war, they love the Iran war, they love the China war. On the other hand, the Republican side loves one war, but not the other. So maybe this is going to be a good outcome for defense stocks and perhaps anything related to inflation. Why? Because the budget deficits will probably continue to stay and expand, and more spending, which is again good for, when we talk about inflation, perhaps good for certain stocks in the industrial and the building side of the equation, but not so good for anything that is sensitive to commodities going higher. Now, what if the Republicans win both, presidency and the Congress? I think that's probably going to be good for at least the major stocks, which could be good for the indices all in all. Why? Because the market might begin to price in tax cuts optimism. But it would certainly be bad for Chinese stocks, for any Euro stocks, for bonds, because the bond market probably saying that a Trump win is not going to be good for bonds. That's why we see yields higher. And would it be bad for defense? I mean, it appears that Trump loves the Iran war, but not a fan of the Ukraine and China war. And that's why I have a question mark on it. Now, what if we have a split, but the Republicans win the presidency and the Democrats win Congress? If that is the case, again, I don't think this is going to be a bad outcome for the stock market because we have a split government. Now you just got to price in what the executive side would do since we have a president that is from a different party. As far as what the Democrats would do in Congress, that can always be vetoed by the president, and he loves to veto. So maybe we have a little bit of concern that the president is switching and now we have to worry about the executive policy. But I think for the most part, I would say sell the news. I would say that the market might breathe a sigh of relief that sure, okay, Trump won, but there's a check on him. And that check would be the Democrats winning the Congress. Now, the Democrats and the Republicans are both anti-China. So I think it could be bad for China stocks, but better for most other stocks. We head back to the hierarchy of events. We talked about the elections in details. What about the Fed policy? When we talk about the Fed policy, of course, the most important thing that comes to mind is what's going to happen with the FOMC. Are they going to raise, or are they going to cut, or are they going to pause? And this is going to happen after the elections, so the accusations of the Fed being political would be all over the place. Cutting before the elections by 50 basis points, and let's say then the Republican candidate wins. And then they say, oh, we're going to pause, or we're going to raise rates now. The Fed will look political. Would that pressure the Fed to just cut 25 anyways? What would be the ramifications on the bond market and thus the equities market too? All of these are good questions. All of these have to be considered for this upcoming week. But what do we think the Federal Reserve is going to do based on the data that we've gotten so far? What we got this week, of course, we begin with the jobs number. And as I said in the program before, the ADP, the private payrolls, that doesn't matter. That's a fugazi number. The ADP should lose all credibility, along with the kitchen from the government. But we have no choice about that. That's the official data. And the non-farms show a growth in jobs by about 12,000, the lowest in years. The estimate was 100,000. Now, of course, on face value, this is a horrific number. A reading that suggests that the economy is probably facing a recession already. But all of these recession fears would be dismissed because during the period of the reading, in the month of October, we had 2 storms, 2 hurricanes in the south. And maybe that led to the reduction in the creation of jobs during the month. And then we're going to revise them higher again. Okay, if you want to play that game, let's play that game. And they can point to the unemployment rate staying the same, not going higher. So it's probably because the storms that we got back to back in Florida and North Carolina and the rest of them. But again, folks, we have to consider the trends. Okay, maybe October was tilted because of the storms. Got it. Let's play that game. What about the trends that we've been seeing about job creation in the economy for a while now, where we see all of these negative revisions month after month after month after month? Maybe the reality of the economy is not that good. Maybe the October reading is actually reflecting a reality in this economy, which is we're not seeing a healthy and robust jobs market as the Fed and the banksters has been talking about. And then you look at the full-time employment on year-to-year basis, it's been trending down. You know, a lot of the creation of jobs in the economy right now is happening by folks taking more jobs, part-time jobs. We know the government been creating a lot of jobs. Most of them are part-time jobs. So if you consider all of that, you look at the private payrolls, in the reading in October was minus. It was a loss of 28,000 jobs. The expectations were for 70,000 jobs. So if you consider all of these things, the case for, jobs market still okay is the weak reading is due to the storms. The case for no, the reading is bad, and you can talk about the storms all you want, but you cannot change the facts, which is the economy is weaker when it comes to the jobs market. Look at the jolts. Consider the fact that the majority of job creation is happening by the government. Consider the negative revisions that we've been seeing so far. Consider the fact that the majority of jobs created in the economy are temporary jobs, part-time jobs, not full, of lower quality and lesser pay. Then you can see the other case, that no, the jobs market is not doing pretty good. Let me know what you think in the comment section. Because if we come up with the conclusion that the jobs market is weakening tremendously, then that prompts the Fed to cut rates in this upcoming FOMC meeting. And maybe this was the initial thinking by the market on Friday's session. Once we got the jobs report, equities went higher, yields went down, dollar went down, suggesting, and even the odds, suggesting that we will see a 25 basis points cut this week. But then came the ISM manufacturing data, and everything reversed. Yields went higher again, dollar went higher again, equities reversed back. What piece of data in the ISM manufacturing reading that prompted a change in the thinking about the economy and the Fed policy? Well, you see, the expectations was for the headline reading 47.6, we got 46.5. Okay, not a biggie here. What's biggie is employment 44.4, which is contraction in manufacturing, and expectations were 45. So missing on employment. New orders didn't go higher by much from expectations, but prices paid did. 54.8, the expectations 50. So combine both of them, higher prices in the economy, weaker labor market. Isn't this a stagflationary outcome? And isn't this why we see gold outperforming? Because a lot of folks say that gold is a protection against inflation. No, it's not. Gold never did pretty good with inflation. Even back in the 70s, gold did better under stagflation. But people don't remember that. People say, gold does better. It's a hedge against inflation because at the end of the day, once inflation became widely spread in the economy, and we actually seen stagflation, folks begin to notice that gold is going higher, and they said, gold just goes higher when inflation goes higher. But gold goes higher when stagflation goes higher. And if that is the case, that we have stagflation in the economy, how could that impact the Fed policy this week? That's what's going to dominate the market after the elections. Assuming, of course, we have a clean result. If we have a contested elections, then forget about it. So we go back to the hierarchy of events. After the Fed policy, we have geopolitics. And the outcome of the elections will have something to do with the geopolitics and will impact the thinking about geopolitics. What we're talking about here is what we talked about last weekend when I said, look, the Israeli response was not the real one. It was just the appetizer. And they're waiting for who's going to win to deliver the real reaction. At the same time, the Iranians are now saying, no. We're going to hit you first. We're going to retaliate against the appetizer that you gave us. And now it becomes a game of who's going to do the initiative first. Who's going to hit who first? And will it happen right after the elections? The moment we got the news that Iran is looking to retaliate, oil prices went higher on Friday's session. And if you looked at the Ayatollah's tweets, I mean, they're going crazy now. He says the United States of America and the Zionist regime will definitely receive a crushing response for what they do against Iran and the resistance front. So, I mean, this is going to be an issue if we see a hit this week. And if either Iran or Israel says, okay, the elections are over in the U.S., let's place the new president in a certain reality when it comes to the geopolitics. And this is why it's high in the hierarchy of events. But after geopolitics, we have the technicals. When I talk about technicals, folks, I'm not talking about a bear flag pattern or a bull flag pattern or a doji candle. All of that is bullshit. It's voodoo science. I'm talking about the technical reactions based on the indicators, which I gave you before. What happens after the election to the dollar, bond yields, and the VIX? Will they move up? Will they move down? And if they move up, they're not good for certain categories. If they move down, they're good for certain categories. That's what I mean by the technicals. So keep that in mind. And then the last element in the hierarchy of events is earnings. We don't want to dismiss earnings because they're still important, but the most important earnings are out of the way. But they're still going to dominate. I'll show you that in a second. But this week, we don't have anything. Monday and Tuesday, we have what I'm looking for, at least Emerson and Yum Brands in the morning. Wednesday, we have CVS in the morning. Then after the bell, we have ARM, Qualcomm, two important chip names. And then we have Corteva, important for agri and the demand from China and all of that. Then on Thursday in the morning, we have Hershey's, Duke Energy, Datadog. And after the bell, we have Airbnb, also good indicator for travel in the economy. Then we got Trade Desk and Square. Not the most important week. The most important one is behind us. But the digestion is happening right now. And the digestion will lead the market to a certain conclusion. What is the finding? What is the summary of big cap technology earnings this season? Number one, these companies are still producing growth in revenue and growth in profits. They're still profitable. They're still doing a huge amount of business. But they're not doing as good as they did before because now we see them spending more. And the rate of growth in costs is exceeding the rate of growth in revenue creation. And that becomes problematic. You can't expand the valuations when you see this dynamic in any company. So the headline reads, Big Tech AI Splurge Worries Investors About Returns. What are they talking about? You can see that CapEx is surging among the mega cap companies, Amazon, Alphabet, Meta, Microsoft. Those have a huge rating in the indices. If investors say, okay, the heydays are behind us and now these companies will spend more, but the growth of revenue is going to slow down, the margin expansion has reached a peak and it's trending down from this point on. The law of large numbers, of course, mathematically becomes impossible at some point to expand margins. But the fact that they're spending more, they plan to spend more, will probably lead investors to that conclusion that these stocks are peaking or peaked already. And if that is the case, then you probably want to get the hell out and switch and rotate to other sectors that are probably going to benefit. We've seen it with Meta when we did the earnings review for Meta. I showed you this. Why did the stock of Meta crash in 22? The growth in cost exceeded the growth in revenue. The margins went negative. So the stock crashed. Then Zucchini sobered up and stopped spending like a drunken sailor on the stupid metaverse and all of that, and fired a ton of employees. So we've seen revenue expanding, we've seen costs, the growth of costs going negative. So the margins all of a sudden expanded, and the stock recovered and went to new highs. What we see right now from the latest report, the growth rate in revenues is slowing down, and the growth rate in cost is moving higher. Are we about to head to the same dynamic of Meta year 22? If that is the case, then that stock is going down from this point on, and the peak is already behind us. And if investors reflect that by dumping these stocks, they will impact the indices negatively because of their weight. And it ain't just Meta, by the way. All of them spending like a drunken sailor. Some would argue that they have to, since we're amidst an AI war. But here's the other headline for you. Amazon CEO pledges AI investment will pay off as capital expenditure surged 81% year on year. You're spending on AI, but AI is not going to show revenue growth until years from now, if it does. In other words, you can put a lipstick on a pig all you want. The margins will begin to contract. The peak of the growth in margins is already here, already behind us. And the digestion of that by investors could be happening this week, and it might lead to a negative outcome. But with that, folks, let's move on to cover the market activities, beginning with the closing of the indices on Friday, and here we go. The diamonds closing positive by 288.73 points, or a gain of 0.69%. The Nasdaq also closing positive, a rebound of 1.44.77 points, or a gain of 0.80%. S&P 500 also positive by 23.35 points, or a gain of 0.41%. And the Russell 2000 up by 1.22 points, or a gain of 0.56%. Now, all of the indices opened higher, but then reduced those gains and went back to the lows of the day as the VIX volatility began to creep higher again. Of course, on Thursday, when you have a flush down in the market and then a lot of folks jump in and buy puts, there are others who also use the opportunity to close puts and actually bet on the opposite reaction. So we see a mechanical element on Friday as we see options expire. And it might produce a rebound after a flush, but then what happens after as we head to a new week? We're probably going to continue the trend to the downside, but we'll see. We'll look at these sectors on Friday. Cyclicals led the way, thank you to Amazon. Then we have healthcare and technology at number 2 and number 3. The laggards, with yields going higher, with the dollar going higher. No need for the dividends, paying stocks, the defensive stocks, utilities, real estate, and of course the energy sector went down because of earnings from Exxon and Chevron. Both of them delivered pretty good earnings, but investors took the opportunity to sell and book profits. On the other hand, you have crude oil going higher, so it might be just a temporary down day for energy. Then we see a comeback. If we look at the week all in all, we have only one sector that managed to close in the green, and that is comm services. Thank you to Google, aka Alphabet. That was the only positive reaction that we got from the big caps, along with Amazon. But the rest, not so hot so we see everything down. Technology leading the way to the downside, so we see the contrast between technology and comm services. Real estate, I think, got exposed this week that it is not defensive. Sure, it pays dividend, but can real estate really thrive if we see bond yields going higher? Not really, and even if bond yields go down, if they go down in a recession reason, would that be really good for real estate? So I think we're finally beginning to realize that real estate is not really defensive. Looking at the breadth on Friday, close to neutral, that's what the market maker loves. In any options expiration, whether it be the monthly or the weekly, they want to close Fridays at pretty much the neutral line to make sure that the majority of the puts, the majority of the calls expired worthless. So we see the NYSE 48% advancing, 51% declining. The Nasdaq 53% advancing, 44% declining. It might look neutral, but underneath it all, if you open the hood, if you look at the 52-week lows versus highs, 114 new lows versus 61 new highs. So the breadth underneath it all was not really good. Here it is on Friday. Once again, a rebound in some of the big caps, Microsoft and Nvidia. Amazon, of course, because of earnings, but Apple went down because of earnings. We talked about the Ozempic mania and Eli Lilly. That's over at this point. The defense contractors went down because of earnings. You see the contrast between Chevron and Exxon in energy. That's because of earnings. I still think that Exxon offers better quality than Chevron. But we'll see what the market decides in the next upcoming weeks. We see utilities, we see real estate, any dividend-paying sector is down because of the surge in bond yields. We contrast this map with the weekly heat map, and now you see the reflection of earnings. The majority of the market was down because a lot of earnings were disappointing, and bond yields, the dollar went higher, so that leads other sectors in the market to go down. The only bright light came from companies that delivered earnings and produced good results, such as Google, such as Amazon, such as Comcast, such as AbbVie, and Abbott Laboratory. Of course, we have other companies that maybe caught a relief rebound for the week because the earnings were not as bad as anticipated. And we're talking about Intel, of course. The other phenomenon is Dell. Dell went higher this week because Supermicro crashed. And now we have questions about the company. And if we have questions about the company, maybe they're fraud. Will the customers continue to buy from Supermicro, or are they going to switch to Dell? And that's going to be good for the stock. That's the assumption, at least this week. We'll see what happens later on. When we look at the weekly heat map for the ETFs, The TLT was down almost 1.5%, so it was a massive move higher in bond yields. Relentless. Both bond yields and the dollar, relentless. And I've been anticipating a pullback, at least a pullback 2 weeks ago. It didn't happen. They just keep going higher and higher and higher. And now we get a question why. Legitimate fear, transitory fear, or are they all connected? The elections and the Fed policy. We'll see what happens, but the TLT was down. Yields higher. Was that bad for the risk-on, yield-sensitive categories, like the IWM, small caps, the KRE regional banks, the XBI biotech, and the ITB XHP home builders and construction? Well, they did better. The IWM was slightly positive. Regional banks were positive. Biotech was positive. The only one negative was the home builders. And then look at the risk-off category, the defensive category for yields. That is the XLU utilities, the IYR real estate, at least for now, the XLV healthcare, the XLP staples, all of them were down for the week. So, yes, yields went higher. It was bad for pretty much everything that is yield sensitive, but it fared better for the risk-on segments over the risk-off. Then you see the dollar was higher for the week. That was not good for metals. That was not good for gold. At least gold miners were down about 4%. Silver was down about 3.5%. But gold, the commodity GLD, was pretty much flattish for the week. Now, the dollar going higher was not bad for crypto ETFs, at least for now. We'll see what happens. I think crypto ETFs are more in tune, at least for now, with the elections, not the dollar. The last observation is chips down, the SMH, the SOXX, the XLK, the IWF growth. All of them are down because the earnings from the big caps were disappointing, and we've seen NVIDIA pull back along with the super micro. We'll see what happens next week because we have an inclusion of NVIDIA in the Dow, and that caused a little bit of buying at the end. We'll see if that's going to stick or not. We'll talk about that and a lot more in the charts analysis. But we look at commodities on Friday. Unfortunately, I did not get the frame where we've seen the closing of WTI and Brent. So this is not accurate, but the closing was positive. We have seen a rally in crude oil on Friday because of the Iran news and because we also got the news that OPEC Plus is postponing any increases in quotas. It didn't make sense to begin with, and now we have a confirmation that that would not be the case. So I think that oil will continue to go higher this week as we price in election risk, geopolitics, and this news about supply. And again on Friday, when we look at softs, we have pullbacks in sugar. Sugar maybe gave up a little bit of the positive formation that we got in Thursday's session. So we have to see how Monday's going to look like. We also seen a pullback in coffee, but a positive close for cotton, OJ, and lumber futures. Mixed reactions in metals. The defensive gold was doing pretty good. The risk-on metals, not so much. And of course, when we look at grains, the winner for the week was soybean oil. And wheat kind of tried to rally this week, but it's not confirming any bullish breakout yet. So if we look at the week all in all, the winners, cocoa, lumber, lean hogs, soybean oil, and oats. And the laggards, nat gas down over 14%, palladium erasing some of the gains from last week, down about 8%, gasoline RBOB, Brent, silver, WTI, all because the dollar surged higher. Will the dollar give up this week as we get the outcome of the elections? And how would that reflect in the commodities market? One of the most important things I'm watching this week. We move on to the big casino options. What do we see here? Volume moving higher, of course. Friday's options expiration, even if it is the weekly, and it was an eventful week with earnings and news about super micro and many other stocks. So we see volume moving higher in the most popular names, NVIDIA, Tesla, but also for Amazon after earnings and Apple too. And of course, super micro. Because of the disastrous news that we got over the week, MicroStrategy remains a hot gambling table. Now we got news about drunk Michael Saylor now is looking to dilute the shares by about $45 billion to buy more Bitcoin, which is more insanity, but it's working for him good right now. If Bitcoin goes down, then the company goes kaput. Once and for all. Done. So we see a lot of volatility there, and we see a surge in options trading volume. Now in NVIDIA and Tesla and Apple, we've seen a surge in put options. Still the majority of the bets for calls over puts, but we see the puts gaining some steam. The opposite picture in Amazon, more picking up steam in the calls side. And in Supermicro, of course, it's been negative, so we see 59% puts versus calls, but the IV rank is at 100. I was anticipating maybe a rebound Friday. Didn't happen. Maybe the market maker risk was, hey, more puts are in the money. I'm afraid the more puts will be in the money by the end, so let's dump and hedge more. But with the IV rank at 100, most likely, you're at least going to see an attempt for a rebound. And now that we see the Johnny-come-latelys jumping to the puts and super micro, you're probably going to see the opposite reaction this week. But for the rest of the market, the IV rank is reasonable. It's in the 40s, 50s. We're going to see over pricing of options premiums, except, of course, in DJT. We're almost at 100% IV rank. This is going to be an election story. I think whether Trump wins or not, the IV rank is going to crash in this stock. So it makes sense to be a seller of options, even though it involves a lot of risk. If you're not experienced, don't do it. You don't have to participate in every bet. Maybe there's another table that's more suitable to you. Maybe trading Amazon or Apple or Tesla or Nvidia. But of course, when we see a surge in volatility and catalyst for volatility to recede, and that's the elections, of course, a lot of us opportunists begin at least to roll the dice a little bit. If we look at the flows on Friday, bullish flows for Citibank, Super Micro, here it is, MicroStrategy, IWM, the small caps ETF, SOXL, the ultra bullish chip ETF, which a lot of retail investors love. It wasn't good this week, but maybe a rebound coming. We see bullish flows for Capri, for Microsoft, AVGO, Broadcom, Hood. Robinhood was down big, but they're betting for a rebound at least here, according to the flows. And then Tesla. The bearish flows can be seen in the E-mini futures, SPY futures, and SPY, Eli Lilly, AMD, Amazon, fading the rip perhaps, booking some profits. The SPX, the VOO, so all of the indices are getting some bearish activities. And Google, of course, went higher, so maybe now they're fading it. We'll see what happens. But most important to us is the unusual activities. We begin with the bullish ones. These were placed on Friday, so they're betting on this week and beyond. We begin with the TLT. I'm in the camp that I think after the elections, we see a pullback in both the dollar and bond yields. Maybe I'm right, maybe I'm going to be wrong. Who knows? But if that is the case, and we think the bond yields are going to cool off after the elections, then the TLT should go higher. And this is why we see the trader here who bought the 95 calls and they sold the 100 calls for the expiration date November 15th, spending about $1.3 million. And then we have another bullish one for BABA. Now, BABA or any of the Chinese names will, I think, have a relief pop if Kamala Harris wins. So here we see somebody who bought the 130 calls for the expiration date of April 17th, 2025, but they sold the 100 calls for December 2024. This is called a diagonal call spread. The bet here, in essence, that Alibaba will rally higher, but not right away. It's going to be above 130 by April of next year, but ain't going to be above 100 by December 20 of this year. This is why the trader is financing the 130 calls by selling the 100 calls with different expiration dates. All in all, spending about $1 million. And it goes hand in hand with this one right here, JD, another Chinese name. Here, they bought the naked calls and they went all the way to September of next year, 2025. 42 calls, the expiration date September 9th, 2025, spending about almost $1.25 million. And then we have another China-related name, which is Win, W-I-N-N. Pulled back more this week because of MGM's earnings, but two different companies. MGM is garbage, Win is doing pretty good. And here we have somebody who bought the 110 calls for the expiration date of March 21st, 2025, spending about $450,000. Then we got another bullish one for you for Tesla. So it pulled back this week, and somebody's assuming that once we pulled back and we shook some of the sellers off and the weak hands and all of that, maybe higher we go again. And they bought the 250 calls, the expiration date November 8, 2024. Spending almost $1.5 million. Another bullish one for you for Amazon. So it popped higher. Somebody's betting for more gains to come. I looked at it before a few weeks ago and it said it's the only bullish chart in the big cap technology stocks. It's the only one that I'd go with. But boy, that report is not the best either. That report shows an increase in costs and spending. And if the market becomes worried about all of that, even Amazon would go down. But somebody here betting for more gains to come. They bought the 250 calls for the expiration date, Jan 15, 2027. So they're going way in the expiration date. And this is why maybe the trade is not relevant to us right now. But it shows that whatever downside that Amazon is going to experience, it's going to bounce back and head higher again. They spent about a little over $1.25 million. And then we have another bullish one for you here for the XLE Energy. So despite the negative reactions that we got this week and the negative reaction after ExxonMobil, somebody here is betting for a bounce back. They bought the 96 calls, the expiration date June 20, 2025, spending about $1.5 million. And then we have The last bullish one for you for RIOT, Riot Platforms. This is a crypto bet or Bitcoin bet. And somebody bought the 50 calls, the expiration date March 21st, 2025. Spending about a little over $1.25 million. I think this is a bet on DJT winning the presidency. And if we see here the bearish flows, we begin with the IWM. Every time it pops, they faded away. As if the market says, I don't believe this soft landing crap, because the IWM will only go higher if we have a soft landing. So here they bought the 209 puts, the expiration date December 20, 2024, spending about $2.25 million. And then we have another bearish one for you for, not a surprise here, SMCI Super Micro. And they bought the 22 puts, the expiration date December 20, 2024, spending about $1.5 million. Watch that implied volatility. I don't think you can continue to go down with an implied volatility at 100 because the options premiums become really, really expensive. And think about it this way. When options premiums become really, really expensive on one side, in this case, the put side, if you bought these puts, let's say 3 days ago, 2 days ago, even before that, you're probably going to book profits because you want to maximum or capture the maximum value. And just by doing that alone, it gives the stock the possibility of or the ground for a rebound. Now it comes in the hands of the buyers. Can we see folks opening calls on SMCI? If that is the case, then the stock is going to rebound. And then we see the implied volatility coming down. And after we cool off the implied volatility, it might head down again. But it goes hand in hand with this trade right here for NVIDIA, whatever you like. They bought the 128 puts for the expiration date November 22nd, 2024, spending about $1 million. Now again, the inclusion of the Dow, usually it is the cemetery of stocks. If you want to retire growth stocks and call the peak, you include these stocks to the Dow. So for now, we see a little bit of optimism, algorithmic reaction of NVIDIA heading higher. If we see fade the rip right away, and we see more investors getting out because now it's included in the Dow, then you probably want to double down if you have puts against NVIDIA, and this is one of the trades they're betting on that outcome right here. 128 puts, November 22, spending about $1 million. We got another one for you here for the XBI Biotech. Somebody bought the 96.5 and the 94 puts for the expiration date November 15th, 2024, spending about a little over $2.25 million. Now, I don't know if this is an election bet or not. I think both candidates will be banned for biotech and big pharma, at least initially. What about Google? Here it is, long puts, 135, August 15th, 2025, spending about a little over $1 million. So somebody's not happy about the results and they're fading the rip already. We got another one for Meta. We got warnings about spending and the stock reaction was not the best. So we see somebody buying the 515 puts for the expiration date Jan 17th, 2025. Spending a little over $1 million. And here's the last trade for you, a bearish one. It comes against Dell, the outperformer of the week. Somebody bought the 115 puts for the expiration date November 29th, 2024, spending a little over $250,000. Let's segue to the charts and then wrap it up. We begin with the SPY and hourly chart. What can we see here? We've certainly broken trends, but we've left a gap open on the way higher. Now, we can debate the technical patterns alone. This is the charts analysis after all. But I think the outcome of the elections will have a higher or upper hand in the outcome of how this chart is going to resolve. But sake of argument, since we're looking at the technicals alone, the bearish argument is we have a larger inverse ABC pattern. We got the B leg on Friday's bounce, and now we're forming the C. The bullish lens says, no, we have somewhat of a bull flag pattern. We're going to release the energy to the upside and close the gap above. The beauty of this is you'll know right away if the indices are gapping down in the pre-market session, then we're doing an inverse ABC. You know that we have more downside to come. If we begin to rebound in the morning, then you know that the risk of a bull flag playing out is, or at least should be considered. What matters is what we see in the daily chart. We closed 2 days in a row below the 20 days moving average. We have the support of the lower Bollinger Bands, but we're expanding those bands to the downside. All of the momentum indicators are now negative on the daily chart. What is the next support? It's pretty much overlapping the lower Bollinger Bands if we plug the 50 days moving average in blue. So if we lose the 50, we definitely have more downside to come. And that's going to lead us all the way down to the 100. That's in or around 558. Now, if we look at the weekly chart for the SPY, we have a rising wedge pattern that is now broken, and it suggests that we have more downside to come. If that is the case, we plug in the Fibonacci retracement numbers, and if we do them from the October lows of last year, we'll have the next support at 544.37. What I do like is begin the Fibonacci retracement since the bottom of 22, because that was the peak of the bearish wave in the MACD in the beginning of the creation of the bullish wave in the MACD indicator on the weekly chart. So if you do that instead, you're going to have a number in or around 530 as the next support in the weekly. Looking at the Q's hourly chart, same thing. Sure, it looks bearish. We got a breakdown, got it. But we can debate it in both ways. We can say that this is a larger inverse ABC pattern. Next thing you know, we're at 5 or 480 and below. The bullish argument would say, no, maybe we have an actual ABC. Next thing you know, we're above 493. We're closing the gap. The elections are out of the way. The dollar is down. Bond yields are down. And everybody's hunky-dory. The beauty of it, you'll know right away upon the open on Monday which one is playing out. But most important to me is the daily chart. We have, again, a closing 2 days in a row below the 20 days moving average. Support at the lower Bollinger Bands, got it for now. The next support is the 50 days moving average. Let's call it at 482. And if we break that, then we can talk about lower destinations. I think we discussed that before in the program. Think about the trend line. That's your homework. I can't do everything for you. But if we look at the weekly chart, here we have a rising wedge that is not quite broken yet. It's on the way, but we'll give it the benefit of the doubt. If we have a break, then all what you got to do is play the Fibonacci that we played in the SPY. You'll get the numbers of the next pullback. If we look at the IWM small caps, this is the daily chart. So it appears, as I'm pointing out here in the chart, that we have a topping head and shoulder pattern. We got a topping candle. It traded above 222, the important number, but it closed below. It was a reversal. And that reversal was confirmed by a breakdown candle the very next day and closing below the 50 days moving average. Now, on Friday's session, we did recover the 50, but not by a lot. You break the 50 again, you got more downside to come. The dollar, we have a bearish engulfing candle that was never beaten. In my 2 cents, once the elections are out of the way, we should see the dollar pulling back. If it doesn't, then it's time to grab the diapers. But assume that we have a pullback in the dollar. Wouldn't it be good for gold? I mean, gold kind of traded above the top of the bearish engulfing candle at 2,773, but it came back down. Can it retouch the trend line? Can we see maybe the dollar surging Monday, Tuesday, and gold going down to the trend line? And then we see rebound in gold and a drop down in the dollar after the elections. All of these are possibilities. But right now, I'm not seeing any break in trend in gold. I don't see any reason for me to exit my position in gold. I only see reasons to hedge. We talked about this throughout the week, that a good hedge would be buying puts on the GDX. We could see the phenomenon of GLD or gold futures heading higher, but we see GDX gold miners going down. Why? Because GDX is dominated by earnings. And here you can see that GDX lost the 20 days moving average and the 50. It might head down to the lower Bollinger Bands at 3121. Why? Because the biggest weight is New Mount Gold, NEM, and that name crashed this week. And if you look at the weekly chart, it looks maybe heading down all the way to the lower Bollinger Bands. If that is the case, you might see continuing of underperformance by the GDX, while we see gold and gold futures actually heading higher, if not maintaining the gains. The SLV silver down a bit, losing the 20 days moving average, but not losing 29.5. Like I said, if the dollar rallies Monday, Tuesday, you'll see SLV heading down further. If we see the dollar pulling back instead Monday, Tuesday, I'd worry about maybe the dollar is going to move higher after the elections. We actually see gold and silver going down. Again, that's the worst outcome. You don't want to see the dollar rallying after the elections. I'd rather see the dollar rallying before the elections than pulling back. I mean, that is, of course, if you're betting on the stock market to recover or go higher. But anyways, there are other things to consider too. Geopolitics, the earnings, the Fed policy. We talked about that in details just a few minutes ago. What about crude oil? It pretty much closed the entirety of the gap that we got on Monday, and I told you that's going to happen. The weak hands are out. They were betting on Israel hitting Iran, and when the hit was not as impressive as they thought, they got out. And they got out before because they got frustrated. But now we see stronger hands coming back in. We're above the 50 days moving average. The trends are now looking positive again. The bad news, we haven't beaten the possibility of a topping head and shoulder yet. But the good news, if you draw a trend line of resistance, we're above, and we're above the 50. So I think that oil is heading higher. With all of the catalysts that we have, oil is going higher. What do we do with the XLE energy stocks? Negative reaction, almost got above the 50 moving average, then closed below. That's because of the reversal that we got in Exxon, the heaviest weight in the XLE. I think if you see crude oil going higher, or you'll see Exxon and the XLE recovering and heading higher again. If we look at the 30-year bond yield, what do we see here? We talked about the rising wedge. Gave us a pullback all the way to 4.44. but we never lost that support. And now it's almost at the 20 days moving average, or we're heading higher, at least at the time of the recording of this video. Was this the pullback in yields? And higher we go from here? How high can we go? We look at the weekly chart, positive momentum all over the place. The upper Bollinger Bands would be resistance at about 4.66. Is the bond market betting on the Republican to win? Keep that in mind. Either way, bond yields going higher ain't good for the XHP home builders. You look at the weekly chart, we haven't lost the 20 weeks moving average yet. But I think it's a safe bet if we see yields going higher, the home builders will continue to show weakness. So we got DR Horton not looking pretty good. So I think we have more downside coming for the XHP. And now, as we talked about few weeks ago in the IYR, or real estate, in the weekly chart, it appears that what we talked about is playing out, which is an inverse ABC pattern. Now, higher yields are not good for the IYR. Good reasons, bad reasons, doesn't matter, because it's a dividend-paying sector. And if you have higher yields in bonds, you don't need the higher dividends anymore. But in the case of lower bond yields, I think right now, from this point on, if we see lower bond yields because of recession reasons, aka the bad reasons, I think the IYR will head down too. It's going to act more as a risk-on asset than a risk-off. And a risk-on asset right now, but outperforming, is the KRE regional banks. A lot of you said, hey, but what is the reason for regional banks to go higher when yields been heading higher? It doesn't make sense at all. Maybe now the market is beginning to price that in. We see a reversal candle for the week, a failure to close at 59.59 or above. Momentum indicators begin to weaken. Is it setting the stage for a drop in the KRE? I think that's a possibility. I think that's, if you put a gun to my head to bet one way or the other. Looking at this chart, I would say KRE probably going to go down, at least to the lower end of the channel, if not all the way down to 53. What about BABA for Chinese stocks? The 4 hours chart is showing bullish momentum, as we talked about last weekend, but not strong enough. We didn't close above 103. We don't see aggression in the buying yet. There's a lot of fear about the elections. I think this is going to be, for now, more of an election story than a China story, because we got some good macro data from China, but the market didn't consider any of that. The market right now is worried about a Trump election win, which would reflect negatively for China and Chinese stocks. Looking at the VIX 4 hours chart, on Friday's morning brief that I produced in Discord, I told you that you have confirmation lines. Do not trust the market reaction up or down unless you have your confirmation in the VIX, and your bearish confirmation in the market is a close above 23. We didn't get that. A bullish confirmation for the market is closing below 21.45. We didn't do that. We traded below, and the market took that positively. But then when we came back up, the market gave up the gains and flushed down at the end of the day. So it is important that we get a confirmation. But looking at the daily chart, the larger trend, what does it say? Maybe we're forming a cup and handle pattern. And we see momentum indicators turning positive. And if it is a cup and handle pattern, you take the lowest point of the cup to the highest point, and the assumption is the break of the handle will be equivalent to that move. So that's going to lead us all the way to 32.67. We'll see what happens. Of course, if the VIX goes higher, it ain't going to be good for the market. It's going to be led by the declines. Will be led by the most sensitive names to the VIX, Apple and Nvidia. In the case of Apple, looking at the weekly chart, I told you folks, stay patient. This formation is going to break to the downside because momentum indicators have already peaked. They can't stretch their way higher for too long. And now we see them breaking down. And this rising wedge in the weekly chart of Apple is also breaking down. With the news of Warren Buffett continuing to sell his stake in Apple, that's the king of value. And he sees a ridiculous valuation in Apple. The stock is up over 30%, but the revenue growth, if you take out the theft revenue, what we call the services revenue, the company's stagnant, but somehow I'm paying the highest valuation in the company's history for that. It doesn't make sense to Buffett, and it shouldn't make sense to anybody, but to each his own. Then we'll look at Tesla, the souffle, weekly chart. Do we have bearish confirmation of losing the 200 weeks moving average? The answer is no. So for now, we're going to treat this as a pullback. Looking at the daily chart, is there a risk of a flush down? Yes, there is, because we've lost 251, and that could lead to more selling, more folks now booking profits and rushing to the exit door. And if that is the case, clean up the chart. We probably have a double top at about 271, and down we go. But that's a premature assumption. For now, I think that Tesla might find support if it continues to go down to 240, 241. If it breaks that range, then I would say, okay, folks, double top is in, and we're probably going to close the entirety of the gap from the earnings report. But right now, it is way, way premature to make that assumption. The better assumption is, got to pull back. Now we're going to try to at least try, keyword try, to head higher again and break that 271. What about Nvidia daily chart? The number I gave you is 136.59. We closed below, and the importance of this number, it also coincides with the 20 days moving average, and it appears to be a rejection of some sort of the 20. The assumption is NVIDIA heads down to the lower Bollinger Bands in or around, let's say, 129. Now, the monkey wrench is the inclusion of the Dow, which caused the pop after hours in NVIDIA. Whether that's going to last or not, that's a different story. If it doesn't last and it's faded right away, then we're going to stay with this assumption that NVIDIA is heading down to the lower Bollinger Bands. If the reaction sticks and we see more buying, inclusion in the Dow, people are happy about that? I would not. But anyways, to each his own. If we see a positive reaction sticking, then we're going to reconsider. But all in all, in the weekly chart, we have a rising wedge here too. It didn't break down yet. So Apple did, NVIDIA still not there yet. Keyword, yet. And lastly, Bitcoin, tulips, weekly chart. A lot of people talking about over the weekend, oh, Bitcoin is crashing. What are you talking about? There's no damage here. We're still above the sloping line of resistance. We haven't done anything bad here. Momentum is still positive in the MACD indicator. It would crash if Trump loses. If he wins, we'll head higher again. So unfortunately, this has become an election play. And technicals, one thing, betting on elections, aka a mechanical factor, because you're betting using options, and then we see the market maker reacting based on the outcome of the elections, based on the options market formation. That's why it's a mechanical event. So that's the risk that you have to consider. If you own or you're short or you're long Bitcoin, just understand that it's more of an election play right now than it is a technical play. Moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, we got factory orders. Tuesday, elections day, trade deficit, and the ISM services survey. Is it also going to show price increases as the manufacturing ISM did? Wednesday the 6th, we have the final services PMI. And then Thursday the 7th, perhaps the second most important day after elections. And the reason is we got the FOMC rate decision and the conference by Chairman Powell. That comes, of course, on top of initial jobless claims and the preliminary reading of U.S. productivity, along with consumer credit. And we conclude on Friday the 8th. We got consumer sentiment, preliminary reading, and then we have more Fed zombies speaking after Powell, from Governor Bowman to St. Louis President Mausoleum. But also the options expiration from November 8 will be really important because we have a lot of election betting. Yeah, so Friday the 8th will probably be more of a mechanical day. On the earnings calendar, once again, Tuesday we have Emerson and Yum Brands. Wednesday we have CVS, ARM, Qualcomm, and Corteva. And we finish Thursday with Hershey's, Duke Energy, Datadog, Airbnb, Trade Desk, and Square. But with that, folks, I hope you enjoyed the show. If you did, return the favor by subscribing to the channel, leaving us a nice comment in the section, and pressing the like button. And better yet, consider joining us as a member here on YouTube or Patreon, links in the description. And that way you can access all of the videos that we produce for the week. And if you choose, join us in Discord too. Besides that, folks, this is all I got for you for tonight. Once again, thank you for listening. Thank you for watching. I appreciate and love all of you. And I hope you had a great weekend. I'll be talking to you again tomorrow. Good night.
You really buy into all this crap. All this take back the country nonsense.
I don't care if he happens to be leading in the polls, and I don't care if he happens to have all the right tools. The truth is, he's the only one that's going to actually make a difference in people's lives. Even the people that hate him. He has to win.
Or what? What? The world's gonna fall apart? It won't matter. Not one bit. To the everyday lives of the everyday fuckers who get up and work and eat and sleep, go back to work again.